The fastest way to lose your dream home real estate purchase is to fall victim to one of these 7 simple steps. And we have seen countless home buyers over the years misstep on one of these 7. And today we're going to dive right into what these 7 are and what you can do to avoid them. I'm Lee Rosa, real estate coach with Glover U. With over 20 years of real estate experience, I've helped countless buyers navigate this real estate market. And with me today is my partner of over 13 years navigating the real estate market, Danny Tokar. Fire away.
Hey, nice to meet you. I'm Danny Tokar from Benchmark Mortgage, your local branch manager here in Plantation, Florida. Thanks for having me on today, Lee. I really look forward to going through all this. Over the years, I've been able to help over 3,500 homeowners in the local market, and fortunately enough, a lot of those transactions have been with you and your team.
I love everything about that. And so today, what we're going to do is break down these 7 don'ts that we have found as pitfalls for home buyers and folks that are getting mortgages and falling trapped to these simple things that hopefully today we can share these as a checklist so that you can use with your clients, and you as a home buyer can mark them down and assure that you do not execute on any one of these, or execute is what the underwriter is going to do to them. If you like what you hear, if you see value in this, share what you like below in the comments. If you really like it, subscribe and feel free to share this. Let's dive in. Number 1, don't change jobs. Now, this is super important because the underwriter's job is to assess risk. In the package at the loan officer, your role packages. And if their job was to change, that changes a major fact in this package that we submitted. And so what are some ways that if someone was to change a job, the underwriter may not see as risk?
So if somebody were to change a job, let's say there was a W-2 salary manager, and they took another job as a W-2 salary manager at another firm, similar line of work, similar type of work, that should be okay. Somebody goes from a salary position that's guaranteed hours, and then they switch job to an hourly position that's not guaranteed hours. That's where we see a lot of problems.
So don't change jobs until after you get the loan.
Or speaking to me first.
And that's fair. And yet we can, hopefully we can see why changing jobs is a high risk move while getting approved for a loan.
Sure.
Let's move to number 2. Don't buy a car, don't buy a boat, and don't buy any big ticket items while in the approval process of getting a loan.
No, that's great advice, and the reality is that when we package up that file to submit to the underwriter, we're calculating the borrower's debt-to-income ratio.
Hold on. Debt-to-income ratio. What exactly, if someone was a kindergartner, does debt-to-income ratio mean?
So basically, the debt-to-income ratio is the total debt that the borrower has, the minimum monthly payments that are showing on their credit report, plus their new housing payment divided by their total income.
Debt-to-income ratio is the ratio at which the lender sees risk based on what they bring into their household and what they have going out in bills, debt, etc. And so based on the product that a borrower qualifies for, or that a lender like you are able to support or share, the ratios are all variables. And so when someone buys a car, during the process of being approved for a loan, it throws a curveball in the debt-to-income ratio, which more than not will decline the loan.
Depending on where they're at, So a lot of times people are already pushing the maximum debt-to-income ratio. So when you add another big payment on top of that, you may go over the threshold that's allowable.
All right, which brings us to number 3. Don't use credit cards excessively or let your accounts fall behind. So using credit cards excessively would be raising your debt-to-income ratio, and it also shows what?
So the lower your revolving credit debt is, the higher your credit score is going to be. So for simple math, on a $1,000 credit card, if you're able to keep that balance to $300 or less, it's going to provide you with the highest algorithm for the credit reporting agencies, which will then affect your loan positively because you're going to have a higher credit score, which will then allow you for better terms and better loan products. Ultimately, whenever you use your cards excessively, 2 things happen. your credit score is going to go down and your debt to income ratio is going to go up because the minimum payments are going to go up as well.
And that's a red flag for the underwriter. Which brings us to number 4. Don't spend the money that you had already put aside for closing.
So we take a lot of time up front to make sure the customers know exactly what everything's going to cost, not only from a monthly payment perspective, but a cash out of pocket perspective as well. It's really, really important that when we get to the closing table, that all that aligns. Anytime there's money that needs to be spent or money that needs to be moved around, I always recommend checking with us first, but you always want to make sure that your money's sitting in the account for at least 60 days prior to purchasing.
Money for closing costs, down payment, and closing costs should be seasoned, set aside for around 60 days prior to closing.
We're going to collect the most recent 2 months of bank statements. Any large deposit on that bank statement, we're required to document and source, and that's where the underwriter is going to look to poke some holes.
Okay, poking holes is how we're getting to these don'ts. We're helping you explain, we're helping our viewers explain how to communicate this with their clients and home buyers like you to not spend this money. And so one of the things that we always ask our home buyers is, if you found the perfect home, where would you want your payments? And by payment, I mean principal, interest, taxes, insurance, mortgage insurance if we're not putting 20% down, flood insurance. In South Florida, we absolutely recommend flood insurance, and HOA if there is one.
Yeah.
So once we know what that nut is, PITI plus MI plus flood plus HOA, then we want how much cash do you have to put towards the purchase. And cash towards the purchase is down payment, closing costs, which we're talking about should be seasoned for 60 days. And any amount we're borrowing or getting as a gift, we want for 60 days.
Maybe. So,
Okay, go ahead.
so that's where we're on the front end of the process and we're doing our analysis. If there is a gift, if money does need to be moved, we're going to analyze every situation individually. But a lot of loan programs do allow gifts to be wired directly to closing and accompanied by a gift letter filled out and signed and put into the loan package.
So let's talk about a gift letter. What is a gift letter?
A gift letter is essentially a letter from the individual that's gifting you the money. In most loan programs, it is required to be a very close friend or a family member. And that gift letter is going to basically document who you are, what your information is, how much money you're giving, and what account it's coming from, and the date it's being wired. We're going to take that letter accompanied with the wire directly to title and a few other documents and then put it together in the loan file for the underwriter to review.
And again, underwriter reviews. So in this number 4, don't spend the money that you put aside for closing. It's because you're submitting that this amount of money is in an account, and if that money isn't in the account when the underwriter reviews it, we got a red flag.
Yeah, and that's a great point to point out, because the reality is that we're submitting these loans under certain criteria. So when that criteria changes, there could be a solution or a problem that happens as a result.
Number 5, don't omit liabilities and debts that you have, which means if you're asking someone to borrow money, don't lie. And if someone was to omit, it's gonna be found.
100%.
And don't be silly. Yet, I think it's so important that it's brought up. Like, hey, be honest, be transparent. We're all a team. And if it's on the table, we can come up with a solution. It may not be a solution that you like, but we can come up with a solution. But if you lie, they're gonna find it.
Yeah, and that's a great point. This day and age, there is a solution for almost anything. The more information you give us, the more we can put you in the right loan program. The more we can go through and navigate through all the different programs, guidelines, and different things that are out there to make sure whatever your debt, whatever your liabilities, whatever your income, credit, and assets are, we have a program for you.
You know, and I love this because when buying a piece of real estate, depending on what state you're in, it's called escrow. And the real estate agent's job is to protect their client's escrow. And so when a loan officer underwrites and has a pre-approval, anything that changes from the loan application is now a variable where the escrow becomes at risk because it's a curveball that was thrown that, number 5, don't omit debts and liabilities that you have.
Yeah, and just the most common thing that is omitted is things like properties. The property may be free and clear. They don't realize, I don't have to disclose this. We run a fraud report and a property that they own shows up. All of a sudden, we've got another liability, another payment, more taxes, more insurance that we have to account for in the debt to income ratio. It happens.
Yeah, well, it happens, and transparency always wins.
Always
Wins. Stay tuned to number 6, because it's the biggest myth in real estate. Stay tuned, you're not going to want to miss it. Number 6, don't originate any new inquiries to your credit. One of the biggest myths in buying real estate is, hey, I don't want to speak to multiple lenders because I don't want my credit to get dinged. And this, number 6, is don't originate any new, which is counterintuitive. And yet, let's first talk about why they're different. Number 1, don't open up a credit card. Don't apply for a car, which kind of is all the going outside of the loan purchase process. Yet why is it important that, or what is the rule, what is the guideline for a purchaser to shop and find the best product for them, whether it's with a direct lender, a mortgage broker, or a corresponding lender, to find the best product for them?
You have a 30-day window anytime you're shopping for a loan, whether it's an auto loan or a mortgage, that you can pull your credit with any lender and not have multiple hard inquiries affect your credit negatively. You have a 30-day window. My recommendation is that if you're going to be shopping, that's the time to do it. After you surpass that 30-day window, that's when the hard inquiries are going to start to affect you negatively. To answer your question on the products and what may be the best fit for the client, a lot of times you may find that at the first lender you speak to. And if you do, that's amazing. But sometimes you may realize that you come up to some obstacles and there might be something that you have to go outside the traditional box for.
So in other words, hey, I don't want to speak to another lender because I don't want my credit to get dinged. The first question an agent should ask is, when did you speak to the first lender? Yep. If it was this week, if it was last week, we have a great opportunity to help them speak to a great lender like you.
Yep.
And at least compete to help them find the best deal.
Sure, and I would say if it's after 30 days and it's a matter of getting them to talk to me, then you go ahead and you make that introduction.
Well, because you'll make it worth the while.
Yeah.
The myth that, hey, I don't want my credit to get dinged, or hey, I'm already speaking to a lender, the opportunity right now for any agent, any borrower, any home buyer is that when banks compete, you win. And should you be approved by ABC 123 mortgage company to allow a partner like you who can help navigate the process stronger than others, the fear of not interviewing, running the credit, of really baseless fear isn't valid. The myth is it will hurt my credit if I speak to multiple lenders. And the truth is that the way it's designed is that you have a 30-day window to interview, run, and shop the opportunity. And it would behoove anyone who's working with a home buyer, or if you're looking to buy a house, to bounce off of you to give you the at-bat. And your contact information is gonna be below, and hit Danny up, because when banks compete, you win.
Yeah, and this is one of the largest financial transactions, quite possibly the largest financial transaction of your life. It's extraordinarily important that if you're not comfortable where you're at, if there's anything that might not seem right, get a second opinion. It takes 15 minutes for us to have a conversation, understand intricately what you're looking to do, and try to place you in the right loan program that helps fit your goals.
And there are lots of different programs out there.
Tons.
And that's why speaking to someone like Danny, if you're already approved, makes financial sense. Number 7, don't make large deposits without first consulting with your lender.
Yeah.
Why?
Like everything else, the underwriter is analyzing the risk on the file. So anytime we have a large deposit, we need to document where does that deposit come from. Now, if we can trace it back to where the originating source and that source is acceptable, all is good. But many times people without realizing might take mattress money, might take safe money, might take money from inside the walls, put it in their bank, go to buy a home, and there's no documentation of where that money came from.
And how does one document where money comes from?
Cash essentially can't be used.
Ooh, okay.
So even if you take cash from one account and then 5 minutes later deposit that cash into another account, there's no way to really trace to make sure that's the same cash. I know that sounds silly, but from a documentation standpoint, there has to be a paper trail. Paper trail is any sort of electronic form or paper form of where that money came from.
So in other words, a W-2 or a check or stuff like that.
Yep. So if somebody's 1099 and they're getting paid by a vendor, there should be a copy of that check, maybe even an invoice that goes with that check. If someone's receiving a Zelle, same thing. There's going to be a digital copy of that Zelle. Depending on the amount, it may or may not be able to be used. Every dollar that moves from one account to another, we've got to document where that dollar comes from.
And if not, it's not you saying, hey, you can't do this. It's just that there's red flags that are raised because of people that have come before us that tried to pull fast ones like this, borrow money, and then do other things.
Yeah. Every guideline stemmed from somebody doing something at some previous time.
Make sure you like this video so that less people make the mistakes and lose out on buying their dream home. If you like what you hear, please subscribe. And if you're an agent and you want to learn more about how to bulletproof and navigate the home buying process, text SRC to 55444 to learn more about Sales Rocket Coaching and how these tactics can help you navigate through the changing market. Thanks, Danny.
Thanks, Lee.